Welcome back to the deep dive. Today, we're stepping past, the surface level noise of the daily headlines. We're going to be applying the kind of rigorous institutional grade analytical framework that senior portfolio managers use to figure out the true internal health of the stock market. So we're not just looking at what the S&P 500 did, we're analyzing the structural integrity of the move itself.
That's exactly right. Our mission for this deep dive is focused on four critical dimensions that really determine if the big institutional players were actually accumulating assets or if they were actively distributing them.
And this is based on market mechanics, not just sentiment.
Right. It's an objective framework. We're going to dissect price and volume dynamics, the depth of market breadth, the state of liquidity and volatility, and then finally, the current correlation regimes. This whole filter, it tells us if the market structure genuinely supports the price action you see on the screen.
Okay, let's unpack this. And I think we should start where the biggest money tends to leave its most decisive signature, the final hour of trading.
The closing window is absolutely paramount. I mean, for anyone managing significant capital the last 30 to 60 minutes, and especially that final auction.
The MOC and LOC orders.
Exactly. The market on close or limit on close orders.
Yeah.
That provides a really high fidelity signal. This is where the large players, they need to execute size efficiently. And we scrutinize those volume spikes against the price movement to really discern conviction.
So the crucial distinction here, then, is defining institutional accumulation versus distribution just in that narrow time frame.
Yeah.
What are the specific indicators that separate aggressive buying from aggressive selling?
Well, when we're talking about accumulation, we look for really substantial volume spikes where the price either advances meaningfully or, and this is crucial, it shows remarkable stabilization.
Stabilization. So it's not just about price going up.
Not at all. It means institutional buyers are actually absorbing massive amounts of supply without causing the price to run away from them. It kind of looks like a strong floor being built, but on elevated volume, often right after an initial dip. That's a huge signal that large players are taking down liquidity, but methodically.
Okay, and distribution then isn't just selling. I mean, it's selling with intent.
It is. It's very intentional. Distribution is signaled by these sharp downward moves, typically accelerated by heavy volume. And if you see the bid-ask spreads widen dramatically during that sell-off, that's a red flag. It means liquidity is being pulled and the market makers are getting nervous.
And what's another tell?
Even more telling is when you see the price try to rally, only for a wave of supply to immediately hit the tape and push it right back down. That signals that institutional sellers are aggressively using any little bit of upward momentum as a chance to offload.
Now, the most visible evidence of this has to be the block trades, right? These transactions, often more than 10,000 shares. How much weight should we put on their timing, especially near the close?
Significant weight. I mean, block trades near the closing bell are never accidental. They're always strategic. If we see massive buy blocks consistently executing at the offer price or pushing that final settlement price higher, well, that's just clear evidence of conviction buying.
And the opposite for selling.
Of course. Conversely, if large sell blocks are dominating the dark pools or the lit exchanges in those final minutes, it signals an organized divestment. It tells you exactly which direction the large flows are pointed.
Let's tie this to the overall volume trend. So if the market closes strong, is it always better if that strong close happened on high volume?
Generally, yes. It's almost always better because high volume confirms conviction. A high volume up close suggests the buying activity accelerated or at least sustained itself right through the final bell. The key warning sign we're always hunting for is a divergence.
A divergence.
Yeah, an index that closes near its high for the day, but on noticeably declining volume throughout the session or just into the close, that signals participation exhaustion. I mean, the rally is just running on fumes, and the price increase is being driven by fewer and fewer participants.
That sets the stage perfectly for phase two, market breadth. This is, I'd argue, the most critical structural check, because headline gains in the S&P or the NASDAQ can be completely misleading if only a handful of mega-cap names are doing all the work.
We call that a narrow market, and it's a huge signal of extreme fragility. The core analytical question you have to ask is the entire market participating, or are we just relying on the health of the top 5 or 10 companies?
So the first tool in the toolkit here has to be the advanced decline line, the ADL.
The ADL is absolutely essential. It tracks the cumulative net difference between advancing and declining stocks, and it gives equal weight to every single stock regardless of its size. A truly healthy market has to have a rising ADL that confirms the rising price index.
When they move together, the rally is broad.
Right. It has broad participation. It's healthy.
What's really fascinating here is the bearish divergence. Can you explain why a falling ADL, while the S&P 500 is rising, is such a massive red flag for a portfolio manager?
Well, if the ADL is falling, it means the majority of stocks are either stagnant or actually declining, yet the index is somehow going up. This is only possible if the handful of mega cap stocks, the Apples, the Microsofts, the Nvidias, are just so huge that their individual gains outweigh the collective weakness of hundreds of smaller stocks.
The rally is structurally narrow.
Exactly. It's highly concentrated, and that makes it extremely vulnerable to any stumble by those market leaders. It signals a real fear of commitment beyond just the safest, largest names.
To really drive that point home, we have to compare the market cap weighted index, which is what you see on the news, against its equal weighted counterpart.
This comparison is a classic institutional stress test. The standard S&P 500 is cap-weighted. The S&P 500 equal weight index, often tracked with the RSP ticker, gives the same influence to the smallest stock as it does to the largest.
And the key is the performance difference.
Right. If the cap-weighted index significantly and persistently outperforms the equal-weighted one, it is the clearest sign that the market is unhealthy and reliant on disproportionate returns from just a few giants. When the market is truly healthy, the equal-weighted index should generally keep pace, or at least not lag so drastically. A divergence there just screams concentration risk that can unwind very, very rapidly.
And to wrap up breadth, we look at confirmation through new highs and new lows.
Yes, you have to. A persistent upward trend requires an expanding and healthy number of new 52-week highs. If the index is pushing to new multi-year highs, but the number of stocks actually achieving that same benchmark is shrinking or flat, then the trend lacks confirmation. It tells us that the leadership is getting old and participation is fading, which is just another signal of potential trend exhaustion.
Okay, let's shift focus now from participation to risk perception and market mechanics. We need to move into volatility and liquidity, and that has to start with the VIX. But we're looking beyond just the single VIX number and deeply into its term structure, which means getting comfortable with VIX futures.
The VIX term structure is the curve of implied volatility futures across different contract months. It's essentially a roadmap of the market's expected risk premium over time. It shows us if the market is nervous about tomorrow or complacent about the next 6 months.
And the first state? Contango, that's the normal one.
Contango is the normal state of affairs, yes. The curve slopes upward, meaning longer-dated VIX futures are more expensive than the near-dated ones. This implies relative complacency. The market expects current uncertainty to fade over time. But what portfolio managers watch very closely is if this curve starts flattening aggressively. That signals immediate uncertainty is building up and hedging costs are on the rise.
And the really critical acute stress signal is backwardation.
Backwardation, yes. That's a downward sloping curve where near-term VIX futures become more expensive than the long-term ones. This is basically the market screaming that it needs immediate short-term downside protection. It signaled acute risk perception, and it often precedes or accompanies a major market sell-off. For an institutional manager, it's a sign that the cost of hedging today outweighs the cost of hedging 6 months from now, a critical warning that near-term stress is peaking.
Here's where it gets really interesting. Let's talk about the plumbing liquidity. How do we measure if the market is easy to trade in or if it's incredibly difficult, which just magnifies volatility?
We monitor 2 primary signals, both related to execution quality. First, bid-ask spreads. A bid-ask spread is simply the difference between the highest price a buyer is willing to pay and the lowest price a seller will accept. When those spreads widen across benchmark ETFs like SPY and QQQ, it tells you that liquidity is deteriorating. Market makers are pulling their capital because of heightened uncertainty.
And the second factor is market depth.
Right, market depth. This refers to the volume of limit orders available near the best bid and offer price. Think of the order book like a body of water. A deep market is like an ocean. A huge whale or a large order jumping in causes barely a ripple. But in a shallow market, it's like a small bucket. When large players enter a shallow order book, the price swings dramatically. So reduced market depth means large orders have a much greater market impact, leading to disproportionate price moves and, well, that just exacerbates volatility.
So if the VIX term structure is flattening, spreads are widening, and depth is shallow, the market is signaling some serious anxiety. We can also look at the put skew to confirm that anxiety. Right?
Yes, exactly. The put skew measures the relative cost of out-of-the-money put options versus out-of-the-money calls. If puts are significantly more expensive, it reveals a clearer institutional bias toward downside protection. It's a measure of implied tail risk, that anxiety about a sudden severe sell-off. High put skew confirms that players are paying a premium to insure against large, unexpected drops.
Now for the less visible universe. Dark pools. This is where a huge percentage of institutional volume trades, away from the public exchanges. Why do we need to monitor this hidden volume?
Dark pools let institutions execute massive orders without tipping their hand and moving the public price right away. So we monitor the large block trades in there not just for their size, but for the intent they reveal. If we see major selling blocks, it means institutional divestment is being handled quietly to avoid crashing the public market.
But the real insight comes from analyzing what you call quiet accumulation.
Absolutely. A sustained high volume of dark pool buying, especially if those prints are executing at or just slightly below the market price, signals quiet accumulation. This is an institution intentionally concealing its desire to build a huge position without spiking the public price and hurting its own execution. They're essentially setting the stage for a future rally by absorbing supply discreetly, and when that hidden accumulation stops, the public market often has a lot more room to run.
Okay, our final phase examines correlation breakdowns. Why is it such a systemic risk if major asset classes suddenly stop moving the way we expect them to?
Because stable correlations are really the foundation of modern risk management. When they break down, it signals a regime shift, often one driven by fear or some unexpected macroeconomic pressure. And we monitor both inter-asset and intra-market correlations.
Let's start with a big one, the relationship that defined decades of finance, equity-bond correlation.
The standard relationship is inverse, or negative correlation. When equities sell off risk-off bonds, like treasuries, the classic safe haven, are supposed to rally, that's the whole point of a 60-40 portfolio hedge. The systemic stress signal is when bonds sell off with equities, so you get a positive correlation.
And what causes that?
It usually happens when inflation fears are high, or, even more dangerously, when there is a severe liquidity squeeze. It completely destroys the core hedging mechanism, and it signals that investors are just indiscriminately selling everything to raise cash.
And what about within the equity market itself? What does a breakdown in sector or factor cohesion tell us?
Intra-market correlation analysis looks for internal resilience. So if highly leveraged or high beta stocks, the riskier names, are pulling back sharply, but defensive sectors like utilities and consumer staples are holding up, that's an orderly flight to safety within the equity market. Capital is just rotating defensively. We also examine factor performance. If high beta stocks are significantly underperforming low volatility stocks, that is a clear mathematical signal of rising risk aversion. The market is rewarding stability over speculation.
So what does this all mean? We've covered 5 dimensions: institutional closing volume, market breadth, the VIX term structure, liquidity, and asset correlations. How does a portfolio manager synthesize all this into a single diagnosis?
The synthesis really determines if the market structure is broad and healthy, or if it's narrow and fragile. A healthy, broad market structure shows confirmation across the board. The index is rising, the ADL confirms the move, volume is confirming conviction, the VIX is in a stable contango, liquidity is robust.
And the recipe for a structurally fragile, narrow market.
That's all about divergence and concentration. You have a rising index, but a flat or falling ADL. The rally is being carried entirely by a few giant stocks. And this concentration risk gets compounded if the VIX curve is flattening or in backwardation, and if market depth is deteriorating, which means it would take only a small shift in sentiment or a modest increase in selling to cause huge price swings. And honestly, the subtle shifts in VIX structure and dark pool activity are often the very earliest warnings of this fragility.
If we connect this to the bigger picture, this entire framework is designed to move beyond the ticker price. It's an ongoing diagnostic to determine whether the foundation of the market can actually support the weight of the current valuations.
That's the goal. It's not to predict the next 100 points, but to understand if the large players are accumulating inventory because they believe the rally is supported, or if they're distributing into strength because they think the market structure is just too tenuous to rely on.
So you now have the institutional roadmap for diagnosing market structure. You can use it to look past the headlines and examine the true state of the market's plumbing.
And here's a provocative final thought for you to consider. We highlighted the systemic danger of a positive equity-bond correlation, the failure of that traditional hedge. But what happens if this flight to quality starts seizing up entirely, and liquidity deteriorates not just in equities, but even in traditionally safe haven assets like short-term U.S. Treasuries? If the large players can't even find a safe harbor, it signals truly indiscriminate, liquidity-driven selling, where the ability to just transact trumps any and all valuation concerns. That is the ultimate signal of systemic distress.